welcome to the Capital Discussions Market Analysis and Week Ahead. I'm Maker with Jerry Furst and Jim Riggio. Before we get started, a little disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. If you don't know your situation and have no way of knowing what level of risk is appropriate for you, we're not making any specific trade recommendations. Risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that little disclaimer out of the way, interesting week at the end of last week and a big continuation today. So Jerry, welcome back. Jim, nice to have you here, and I've given you the ball, Jerry, so you can share your screen.
All right, great. Very good. Tom, Jim, how you doing?
Great.
Good, sir. Yourself? You
Very
surviving?
good. Yeah. It is. It's an interesting times, as the Chinese say, huh? So today is. Well, let's go ahead and let me just bring this up on the big screen here. We'll get to the live charts in a minute, but I spent some time putting together some prepared presentation. So today is Monday, August 24th, 2015, and good morning, good afternoon, good evening, everybody. My name's Jerry Furst, here on Capital Discussions for the Week Ahead webinar. And join us every week on Mondays, and in fact, I was speaking with Tom earlier today. We'd like to maybe have a poll as far as would people like to see the webinar maybe at noon to 1 o'clock Eastern Time? If you'd like it to stay at 4:30 Eastern Time, we'll see. If more people like, obviously for those of you who are here at 4:30, maybe you like it at 4:30. The people at 12 noon aren't here. But what we're going to do is have a special webinar this Thursday at 12 noon to take a look at how the week has progressed. This is the week ahead, and we're going to take a look at the week in progress this Thursday at 12 noon. And so join us. This is a screenshot that I took a couple of minutes after 4 o'clock on the Dow. There's a reason why I'm focusing on the Dow. It's because what I primarily focus on is technicals, charts, and patterns. I do include the fundamentals. I have to include the fundamentals, but if you take a look at this pattern that's forming, what we did today was complete an entire cycle in the last few days. Well, we've actually got a little bit more to go down, about 14,800 if we wanted to put in a good solid bottom on the Dow. I have a friend of mine that calls me up every once in a while. I went to high school with, and whenever he goes ahead and calls me and it's like, oh, the market's going down. He called me last week when the market was down about 350 points. And I told him, wake me up when we're down 1,000 because we're trading at 18,000. So 300 points, 500 points, it's like a bump in the road. 1,000 points gets some people's attention now. And we had a beautiful pullback reversal after about the first half hour. One of my clients I talked to this morning, I was saying we've got better than a 50% chance that we could close the day positive. And we almost got there. But
I tell you, I thought the same thing at 1:30. I was speaking to somebody right after lunch, and I was like, this would be just the way it had set up, Jerry, like you were saying. The sell-off in the morning, we were on huge volume, and we were coming back strong, and I thought that there was a 50-50 chance that it could end up continuing going up. So it's we were right thinking the same way.
Exactly. And, it's interesting. I do torture myself and watch CNBC occasionally. And there's a couple of people on there that I won't mention names. It doesn't matter. The 90% of them have never seen any major market moves. And the guy admitted it. This one guy, he loves talking about Apple every day. He goes, I've never seen a day like this in my life. And He's talking to somebody that looks like she graduated high school when I was watching the market, and so they're in awe. But for people like Jim and myself, you get used to these things when you see these patterns, and these are the moves that option traders like myself, love and live for. We get the volatility spiking up. Volatility goes up, you get fat premiums. And the reason why I'm looking at the Dow is that I did a presentation back in September of 2011, and then I did another one on technical analysis in October of 2011. And the one in September I called the fall of 2011. The reason why it's interesting is, and this is back with the signal, you can see that we had this huge move down back in July that started, and this is when we were supposed to have a downgrade of the U.S. and we were supposed to shut down the government and all kinds of reasons for the market to potentially crash. And you get these huge moves down, and then invariably nothing goes in a straight line. So it's interesting. We had a day like this where we put in a little bit of a fear down here. Look at that, 10,600, Jim. That's only 5 years ago, and we're up 8,000 points from there. I mean, you really got to look at where we've come from to appreciate that a 1,000 point intraday move on the open, it's not a big deal, but it gets a lot of people's attention. Now, I've been doing the webinars here on Capital Discussions since November or December, I think. And I was talking about, there we go, thank you. I was talking about in January when the Swiss National Bank pulled the peg out of the euro, that was going to potentially cause ripple effects through the economy. I was always talking about Greece in the background, and then about a month or two ago talking about how who would have guessed that Puerto Rico was going to default on their municipal bonds. Well, I would. When I start seeing, pundits come out and trying to sell municipal bonds, Puerto Rico municipal bonds to the general public, it always makes me wary that they're trying to push the institutional risk off to the retail investor. So I want to go back and look at the past, and then we'll move into the future. This is a side-by-side comparison of 2011 versus 2008, and the plunge of 2008 we're still recovering from. And what happened in 2011 over here was that right about here in August was when we ended up with QE2. And it's coming right upward. That was done with Jackson Hole. QE2 was basically announced just before the Jackson Hole global economic event, which, by the way, guys, is coming up this, where's my calendar here? Oh, come on, Jer. The economic calendar for the week ahead, we have Jackson Hole starting out Thursday this week, along with GDP announcement. So it's interesting. For those of you who haven't heard of me or seen me before, I mean, this is me inside the Board of Governors room. Here I am sitting this is not really the head of the table. That's just over by the fireplace where they burn the documents and the people. Well, I shouldn't say it. But anyway, you've got this is Bernanke's chair back then and there. Here's Ben. And this right here is the deputy director of the IMF. It's already been a while since I forget. And this is Mr. Shepard, president of the U.S. Chamber of Commerce. I was invited over to not only the Fed, but also in Miami, a branch of the Fed. The Miami Fed is a branch of the Atlanta Fed. And this was in October 12th of 2011. And so the man who was doing the presentation on October of 2011, if you take a look at the chart right here, that was this spike, this day right here. And he was visibly drinking, or he admitted he was drinking on the plane as he was putting his PowerPoint together, talking about the TED spread. And so that's pretty much what I would consider a bottom. When you see that, even the people at the Fed are panicking, it's like, that's it, it's over. It's time to go ahead and rally the market. So it's mornings like today when you see that we're down about 500, 800, and when you start seeing the Dow, remember the Dow is 30 components, and you've got all the S&P components and the E-minis dragging the index hundreds of points in a matter of minutes. I mean, it is an amazing thing to watch when you're down 800 and then you're only down 300 and then you're down 1,000. You got to blink. What is very frustrating is I'd like to know how many of you guys and gals had problems getting trades or execution through with your broker? Because I know I had trouble getting through mine. I noticed a lot of delays and a lot of reconnections, and there's nothing more frustrating. Yes, I thought somebody was beeping in here. There's nothing more frustrating when you have the market moving that fast and you are unable to connect. And one of my tricks is to have my trading platform on my phone at the ready, and even that would not connect. So,
Tom and Jerry, we did finish 500 points off of the bottom if you want to talk, Dow Jones. So, that panic selling, at the very open was just incredible. I know we sold off, in the late afternoon, but my God, did we have a vicious, bounce back up off of the initial sell-off, when the market opened.
Absolutely. And what was that vicious sell-off at the open? Most likely it was all of the European and Asian markets that had sell orders, not by choice. Most likely those were the ripple effects of the margin calls that came in over the weekend. From our 530-point close last Friday, which was a result of, China and Greece and all these other issues that have been causing these ripple effects. So remember, it takes about 3 days or so, or at least it used to take about 3 days for the margin calls to come in. These days, it could happen instantaneously. One of the things you have to be careful of with your options trading, for those people who are using, let's say, you're putting on spreads, your short side could potentially get closed and you could get whipsawed in and out of your trade very, very quickly if you're not careful. So depending upon, what you're in and how you're positioned, you may think that, I have very little risk and I'm covered because I have a spread on. There are conditions that can happen in fast-moving markets, and this is where that little pamphlet with the toilet paper thin characteristics and risks of options comes in. These are the days when you can make a lot of money and you can lose a lot of money. So I encourage you, if you haven't been through it before, study the past and prepare for the future, because in my opinion, we're not over. When you have such a move as we had today, the odds are that we're going to go ahead and notice that I've got a Fibonacci right here. It's 123.6 Fibonacci extension that called this bottom right here. Okay, I'm going to go ahead and draw a Fibonacci from that bottom, to the ultimate top up here. And how do you like that? Okay, and I kid you not, I didn't, is that, how remarkable is that the 123.6 extension on the daily chart from this low going back to October of 2014 to the peak here in April, May of this year. I mean, we basically just tapped that right there. It's close enough for government work. 123.6 fib. Anybody that makes fun of Fibonacci's, I just have a whole different opinion, or send them my way. So anyway, so lesson number 1 today, Fibonacci's. Use them, learn them, live them, love them, or talk to me. Let's see, if we go back over to the PowerPoint slideshow. So one of the things that I look for are patterns. And so notice the similarities in the 2007 pattern repeating in 2011, 2008. You have this huge run-up. And notice I have point A over here. So you have this run-up here to point A, B, C, D, E, F, G, with a huge rush down to H. The reason why I had a question mark there is that I was doing webinars and live presentations back in 2008. No, right here. Back on this chart. This is the 2011 chart. I was having presentations at this point right here saying that could this be the extreme fear where that's the bottom? And notice what happened with the market at that point in 2008. It then rallied up to the 50-period moving average, came back down, but made a higher low, I should say. And then it rallied up to the 200 moving average, and then put in a lower bottom in July of 2008. Going back, taking a look at you can see that that's pretty much what happened here too. It rallied up close to the 50 moving average in 2011. In October, it put in a low before rallying back up to the 200. And it then continued to go up because QE was continued, interest rates stayed low, and we just continued forward. Okay, so that's a little bit of a history. 2007, 2008, 2011. Now, are we in a correction territory? The next few days and weeks will go ahead and tell us whether or not we're going to have a real correction, because we definitely have the headlines for it. We got more than enough headlines for it. But we can always have intervention, so that even though all the reasons in the world are overdue for a real 30, 40, 50% correction, it can be mitigated. And there's good reasons to say that Superman should save the world. And then there's other reasons to say that, you know what, maybe you gotta let some of these things go. I've got puts on Kodak right now. And Kodak, been around a long time, used to be a major Dow component. Sure is a good name to put on top of a company, but, they missed the boat on digital photography. So companies like Kodak may or may not survive a major pullback, but other companies such as, Chipotle Mexican Grill, I'd say they're probably going to make it through this round. What about McDonald's? Well, I don't know. So here's the daily chart of August 24th today. This was taken around 1 o'clock. And you can just see how dramatic the move down has been for the past 3 days. Here's the S&P 500 over here. Here's the Dow. And you can see the correlations. This is the euro over here. So the euro going up as money goes into cash, or at least over into the euros. And here the dollar index actually going down. So sometimes it's kind of strange when you look at the commodities, the Australian dollar on a daily chart, you can see is just continuing to go down. That's reflective of the economic slowdown around the world. The yen got crushed. This is the dollar, I should say, against the yen. And here we have gold, which amazingly has really, look at the support resistance level on gold. Just a lot of people are really scratching their heads thinking that gold should be rallying, but it ain't happening. And oil, otherwise known as black gold, broke the 40 handle and closing in the 38 range. Let's see, I've got the live charts. Any questions so far? Oil closed, well, it's at 38 futures right now. And let's see, I think for those of you who are just joining us, Jerry Furst here with Capital Discussions for the week ahead. We're having a little poll. Type into the chat in the comments section whether you'd like to see this meetings continue at 4:30 on Mondays or whether 12 noon to 1 o'clock is something that you'd prefer. Thinking about shifting that to the midday.
And I'll set up a poll, too, for people watching the recording and also on the blog and stuff. So you don't have to type it in now. It'd be nice, but we're going to set up a poll to get more accurate numbers.
Okay, great. And also another plug for this Thursday at 12 noon, we're going to do a week in progress. So we don't know where tomorrow and Wednesday and even Thursday morning is going to be, but we'll go ahead and we'll get into a webinar Thursday at 12 noon to go ahead and see, where we are at that time. So this was a chart of today, and this was from last week, August 17th. You can see, just the dramatic drop-off as I shift back and forth. Want to go ahead and move forward a little bit. This is the weekly chart from last week, August 17th, where, look, the market's just, here's the NASDAQ, here's the S&P instead of the Dow, but just going skyrocketing as last week. This is the 5-minute chart the 1-hour chart from this morning. You can see the dramatic future, the overnight session with the futures, with the dramatic sell-off in the morning on the S&P. There's a hammer on the NASDAQ on the 1-hour chart. Here's the dollar-yen overnight just completely crashing. And so those are all the, the dramatic, reasons why we had. Look at the Australian dollar. So the commodity is completely getting crushed. Surprising strength in the euro. The pound, actually not as much. I mean, it's held up, but it's interesting. So that's more of the global picture. Yeah, here's a slide I put in to make sure that I didn't forget. We'll have the week in progress this Thursday, August 27th at noon Eastern time. Focus on the recent volatility and weekend planning. So play on words. It'll be for the weekend, for the week ending planning. And, every week is expirations now. So none of these presentations or charts should be intended to be a recommendation to buy or sell anything. It's strictly my opinion on what I see in my experience and what I might do. I might go ahead and tell you or even work through a trade that I'm considering, but it by no means should ever be considered as an endorsement to trade because you never know what can happen from minute to minute. Great example was Google a couple of weeks ago. After the close, went ahead and announced their Alphabet, what would you want to call it, split. It's an interesting topic all by itself. So here's a screenshot from last week. Had a technical issue, so I wasn't able to do the webinar, but notice that we were trading at 1313 when I did the screenshot of the VIX last week. And what I was going to point out was that we had resistance at about 20, and I was expecting it was time, in my opinion, to see us get out of the teens and back into the 20s. And so let's take a quick look at where the VIX went and closed today. All right. So here we had a beautiful spike up in the VIX this morning over the last couple of days. So that was, notice, my chart, if I can move this back to last week. This is where we were about a week ago. And I was saying that, we really should probably be getting back up to, the 20 range. We have a fib cluster up at about 21.5, and then we've got another cluster up at 27.25. We have another fib cluster up at 40.6. Little did I know that, okay, so we went ahead, look at that. We closed at 40.6, and that's exactly where I had put the arrow, way up there with all of the fib clusters. Once again, another Fibonacci coincidence? I think not. And so what happens now? For those of you who are, kind of new to the game and VIX and volatility, the volatility is when the volatility goes up, the premiums on your options go up in general. And so it's a good idea to go ahead and sell the premium when you have these moments of fear. I'm speaking in generalities and nothing specific. It was interesting to watch while the market was cratering which stocks were holding up. And Twitter being one of them, actually. Twitter today, to digress for a second, holding up relatively nicely on the day. It dropped just for a couple of minutes, just on the first few minutes at the open, and then it basically came back up to neutral. So when you have, my analogy with the VIX is that typically when you see a gauge like the VIX, Volatility Fear Index, it measures the number of puts being bought on the S&P 500. Options were originally designed as hedging protection for hedge funds and institutions that wanted to insure their accounts in moments of volatility. And so that's how, and the reason why options were originally created, not to the monstrous derivatives that they've become that allow us to have all these fun opportunities. But the idea here is that I consider this to be similar to a tachometer on a car, where your car engine can only run at a high rate of rotation with your engine before it'll, snap a rod, blow a piston. And so the same thing happens with the VIX. You have these moments of fear and panic that you just can't maintain it. It's something will break. So you'll have that spike up, and that's why Jim and myself, who've seen these things before, we're pretty comfortable with the fact that there's a good chance that at least whether it's just for the moment or for the day, maybe for the time being, we've seen an initial releasing of the pressure that needed to be released on the market. Now, for those of you who are lucky enough to have sold options, Friday, covering them this morning at about 9:35, if you could get your order through, would have been fantastic. And in fact, some of the people that I coach and train, I was talking to this morning as the volatility was coming out, and I was saying, hey, I'm not telling you what to do, but you might want to go ahead and cover that option that you sold at $3.50 if you can buy it for 40 cents. I don't think, waiting for another 20 cents or to see it expire makes no sense. So for those of you who are well experienced, you know that. For those of you who are still learning the game, consider this to be a great time to be learning what happens during market volatility. Jim, anything you want to add as far as the VIX goes? Tom?
Yeah, I'm curious, Jim, if you have a chance, how did it go with the institutional hedging and all the volatility work you've done? And I don't know if Jim's available or not.
He may have stepped away from the mic. We'll go ahead and we'll move into, let's see here. Does anybody have any questions? Any individual stocks or index questions we can go ahead and get into?
Well, before I do that, you might want to, if you have a browser handy, pull up VIX Central, and you can see that the VIX futures are in backwardation, which I know is one thing Jim has talked about in the past that kind of shows a level of fear in the market.
Okay. VIX Central.
That's it.
Right.
You can see the September futures are priced higher than the October, and normally they're not, so that's backwardation.
Would you?
Yeah.
You want to take over and just go through the website and just show this is the site I'm not all that familiar with. So it would be probably a good thing if you wanted to go ahead and explain what we're looking at.
Yeah, well, basically that blue line where the September, October, November is plotted, a normal state or contango, the prices move from the lower left to the upper right. And here it's pretty flat with the near term, the most expensive. And, that is considered backwardation, normally is contango. When Jim looks at this, he says like percent contango in that little table underneath the first to second month is normally, I think, 2 or 3% from my memory, but minus 11 is pretty extreme. So the way Jim has explained how he uses it in the past, if he gets a market sell-off, he'll check the VIX futures and see, are they moving towards backwardation or in backwardation? If they're not, then the bigger institutions basically aren't worried about the move down. But today, with this situation, this is definitely one to worry about.
So then the big question is, the VIX is a good representation when people say that charting and technicals are all lagging indicators. I think this is a good example of that because I don't know about as far as the backwardation, the contango. I know a lot of futures traders and everybody's watching those types of things, especially when you have the fronts, they have to catch up with the futures. The question is, okay, so we just saw a spike, and so is it over, or is it just the beginning? Because if you go back, go ahead.
I don't think you can really tell if it's over or not. I mean, it will eventually return to mean reversion, but how long is that going to take, and where are we going to go between now and then?
Exactly. So take a look at, this is a monthly chart of the VIX, okay, going all the way back to 1987. That's interesting. Let me go ahead and stretch this out. 1987, that was the very first computerized crash where the, personal computer, I worked at IBM at the time, and the market was crashing, and I really wasn't. It was just, I had just started my Schwab self-directed account back then. Getting real-time quotes was impossible. All I knew was at lunchtime that the market was having a problem, and my manager said, it's these damn things. He's pointed to the big fat computer on my desk, and I said, what are you talking about? And he goes, it's the computers that are doing it. I looked at him like he was nuts. But he was absolutely right. So that was a spike going all the way up. Could you compare 1987 to today's VIX? I don't think so. But you can just see that as a reference point, look at these other spikes. And it is amazing how these resistance levels work. Notice that 40, 41, 42, I have some charts saved where I've got just my standard VIX support and resistance areas, and they're really just resistance areas. So what I want to get at is, let's take a look at today, where we made it up to about 54, and take a look back for how many times that we've had just a single move up on a month versus multiple months. And so,
Jerry, and if you go by the week, do you remember, Jerry, we talked about the Goldman Sachs report that ended up showing the largest weekly moves in the VIX history? And last year in the fourth quarter, we had 2 of the 10 largest weekly moves in the VIX in its history since it's come out in, 1992, I think. If you take a look at the weekly move that we've had this week, I'm pretty sure, okay, I haven't done my homework to end up saying it's 100%, but I'm pretty sure this is going to be the largest weekly move in the VIX history.
Well, no, this is weekly on the VIX.
You're looking at 1 week. I'm looking at the largest 5-day move. Okay, a little bit different the way Goldman Sachs ended up doing it. But yeah, it's either way, no matter how you cut it, it is going to end up being absolutely enormous of where we've gone. Okay, in this.
Right, and I don't know if you were here before. Tom was showing VIX Central, and
yes, I was.
Okay, because I didn't know if you wanted to explain the backwardation and contango concepts.
I can. The reason why I wasn't able to end up speaking, I was listening to what you said, but Bill, I got a call from EAB with proper disclaimer. They're going to let us forward their newsletter. That was out today. So we can end up bringing it up, okay, and you have to end up understanding it's an institutional newsletter. Okay, the people who end up getting this are professionals. They know what they're doing. If you end up trading this, you can end up losing a lot of money. So, given the disclaimer that Tom talked about before, we'd end up going. The comment that I would end up making about, this curve is that a couple of things. One, the VIX is still much, much higher than the front month futures. Okay. The second comment I would end up making is that this is not a single data point. It's not like we have like a normal contango curve and the front month is up because there's some issue. This is genuine, fear going out, many, many months. Having a 6-8 month, number that's in the 20s is relatively high, but when you compare it to where it is on the front one. The last and the third comment I'd make is that if you take a look at the 6-month future on the VIX, really didn't move up that much. We were at 15, 16, 17, and we moved up to 20.7. So it wasn't like the January, February, Marches ended up having this massive move up. This is feel a full-blown panic. Okay, there's a lot of fear in the market. I'm not saying there isn't, but it's not like this is like an oh my God. Now remember the last 2 times that this has happened. Right, the last 2 times this has happened, what's happened is that the front, and that's a great picture if you stay there just for a second, right? If you end up taking a look at this, right, the curve has changed a lot, okay, here, where what's happened is that the center of the curve's moved up and we've flattened out a lot, and the whole thing is moved up, okay? So this tells me that the fear now is more consistent going into the future, which means that a lot more people are worried. Final comment that you can't see here is that On the put skew curve, meaning if I go out and just take a look at, a single, let's say a 30-day or a 60-day option, what's happened is that the puts below the money used to end up trading at a much, much, much higher rate than at the money or above the money. That curve has also flattened, which means that, which is a good thing, right? Because there's fear all over the place. If I was a long-term investor. By long-term, I was thinking, I'm saving for college tuition or weddings or things that I'm not going to end up needing, let's say, for 5 years. Boy, oh boy, selling cash-secured puts in an environment like this with, limit orders, let the market sell off and end up taking your money, get your position in. What a great way to go. Can you lose money on them? An enormous amount. But if they're cash-secured and your viewpoint is long, it's a wonderful thing. And don't go all in at one spot. Put in 10% today and 10%, in a couple of days, ease into it, dollar cost average into it. It's a great longer term, opportunity. And if you end up getting into the market by selling the puts, you're getting the added value of having the enormous jump in the VIX as a way to end up getting in the market.
Excellent point. I was talking to a couple of the people I'm coaching and mentoring and explaining. Some people, when they first get started, they're programmed to think of things only going up. And I try to explain that you can make so much money during, moments as the market's going down. You don't want to catch the falling knife. But if you liked Facebook at 96, well, you should love it at 70. And why not go ahead? And if we were to pull up, I had rebooted before, if you go ahead and pull up just as Jim is talking, cash secured puts is just such a fantastic strategy during these type of volatility events, because the odds are that just when everybody's freaking out and panicking, could it go lower? Yes. What are the odds that it's probably going to rebound? Pretty good. How do you want to roll the dice? Cautiously, as always. But the idea is that if you take a look at your Facebook, I wonder how Discover's doing. So in this case, well, I don't want to talk about this. If you got 1,000 shares and you already short the 95s, it's a good time to cover at 40 cents, right? And then if you loved, if we were to go ahead and go into NetView and go into BackTrader for this morning at, let's go over to 10 o'clock. It's about time that option view gives us better than just 30-minute increments, but we'll take 10 o'clock. So with 26 days to go, with Facebook at 81, do you think that you could go ahead and sell the 75 put for $2.60, giving you an effective purchase price of about $72.50? I mean, it's trading at 81. Wouldn't you love to own it at 70? If you wanted to buy it at 96, I mean, it's already on sale. I mean, what's the worst that can happen? It rallies away from you. You put $2.60 in your pocket. I mean, selling cash secured puts is something that I think is going to be more and more used. It's interesting. I'm talking to one of my clients this morning, and he made a comment to me. He said, "This is going to wipe out the retail public. After this, they're not coming back. It's going to be 10 more years before people come back." And I said to him, I don't think so. I said that after Facebook was completely mishandled their IPO, because people that were millennials or whatever, they wanted to get in on Facebook stock. That burned them. Now they're a little older. Maybe they're making a couple of dollars with their minimum wage at $15 an hour. And they're starting to figure out, unfortunately, was what I told him, that the market is more like a casino. And so I hate to say this, but it's really a sad opinion. It's my opinion that, how do you value a company like Facebook or Alibaba? But the fact of the matter is, at 10 o'clock this morning, Facebook was trading at 81 bucks, and I could have sold a 75 put for 250. It's a video game. It's a freaking video game. And that's, to me, and you got people like, Donald Trump saying that hedge fund managers need to go ahead and pay more in taxes. So is my client correct when he says that people are going to stay away from the market? The retail public most likely is going to think the opposite. They want to be the hedge fund guy, right, Jim?
Yeah, they do. But, one of the things that you ended up mentioning and I had mentioned, I want to make sure isn't lost on people. That is when we talk about cash secured puts. By having the cash to buy the shares if you are assigned, that ends up giving you time on your side. So you're selling time premium, but you have it, meaning that you're going to buy the shares anyway. By doing that, you can take advantage of other people's fear. Because one of two things happens, right? Either the stock continues to go down, one of three things. The stock continues to go down, at which point you'll end up buying it at a discount than if you would have bought it right away anyway. Your view is long-term, so in the long term, you wanted to do this. And if you're wrong, meaning that if the stock either stays where it is or moves up, you get to keep the premium. But very, very important, the single biggest mistake, and please, if you take anything away from things that I tell you, this is the thing to take away. The single biggest mistake I've seen retail traders make, time in and time out, is that they trade too large and they don't have time on their side because they're not capitalized well enough. Make sure you trade this small enough, and when we say cash secured, I'm not talking about being able to end up using, leverage from, your bonds or something like that. I'm saying have the cash. This is your money. Just make sure you're not trading like that. And so I agree with you totally. Yes, people want to end up being a hedge fund manager, but that also means knowing how to use risk as a tool in your favor, not have it used against you because you're over-leveraged.
Excellent points. Excellent points. We could spend a whole, purchasing stock with cash secured puts, is a whole lesson in itself. And look at this. This is, if you own 1,000 shares and you already short the 95s, you cover that for 40 cents. You still got the 1,000 shares, and now you can go ahead and sell the 72.50. You're still covered. So you end up in this whole cycle where you sell the cash secured put. If it comes down, the stock is put to you. Once you own it, you sell the covered call, and once it rallies up, okay, so if they take it away, you do it again. Either that or, maybe you want to buy some more. It's, to me, these are the days that I really love the volatility. It used to be before the internet was available, I brought in speakers from all over the country, exchanges. Some of the best educators in the world would come down here to South Florida and speak at the hotel room. And now it's too easy to just do a webinar. But we had speakers coming in, talking about options, explaining these concepts, and the computer power that we have now, even just 5-10 years ago, is just amazing. So,
hey, Jerry, I want to make one other point because I have a hard stop in a couple of minutes. I need to get going because I have a 5:30 meeting.
Right.
And that other point that I wanted to making is that one of the things that we did on an institutional basis today was that when the market was moving up, okay, by midday, because the volatility was so high, and the volatility also got high on the calls above the money. This is one of the few times when the implied volatility on the calls above the money gets extremely high because people think, oh my God, this thing could snap right back up. And so there's a lot of extra, if you will, premium on that side. We were actually selling calls, okay, in the market today on the way back up. And this is the point I want to end up leaving you with. In 2008, if you take a look at just a pure, a reversal, meaning you sell a call, buy a put, okay, on the overall market. A lot of people thought back in 2008, oh, of course that strategy made so much money. You killed it on the put side. And the answer is, yeah, they did. But if you take a look at the profits of doing that for the entire year, just doing monthly rolls, only 55% of the profits came from buying the puts. 45% of the profit came from selling calls in that environment. Okay? So make sure that you're thinking about volatility as a two-way street, not just a one-way street.
Absolutely, and that's what options is all about. Thanks for interjecting. I was losing my train of thought. One of the things that I wanted to say also is that a lot of these brokers love to go ahead and talk about selling, condors and, talking about third standard deviations. But you have days like today where you can fly through 3 or 4 standard deviations on both sides of your wings. So I just want to remind everybody that, you want to talk about selling the calls and the puts or buying the calls and the puts, taking advantage of the increased premium and volatility. But, try to be flexible with your strategies and your concepts, because you never know exactly what's going to happen. Just when you think you've got the sure thing, and just when you think that you've got your strategy that's gonna make you the next John Henry, who lives down here and owns the Boston Red Sox and the Liverpool soccer team, football team, it's something to be careful to be hedged, not only in your positions but also in your patience. So we're coming up here on 4:30. Want to go ahead and remind everybody that on Thursday we're going to have a week in progress review to go ahead and talk about where we've ended the week, or coming towards the end of the week, I should say, because we'll still have another day and a half to go. Tom, you have anything you want to add to the thoughts for the presentation?
No, I see Jim has to go, so have a good meeting, Jim. Thanks for stopping by. But as Jim points out, remember good risk management. So make sure that you have the plan in place to keep from losing a lot of money, because the more you lose, the harder it is to get back to where you started.
Absolutely. Absolutely. I can go ahead. One of the other things that I'd like to go ahead and show you is one of the things that I watch, let's say for the Dow, as long as I'm looking at Dow component, Dow index, I like to take a look and see which are the winners and the losers, or which ones lost the least. Notice Intel, General Electric, Coca-Cola, they lost the least as of the close. Who lost the most? Goldman Sachs, United Health. Notice insurance company, healthcare. Donald Trump was calling out the health insurance companies on Friday. Could that be the health insurance companies have had a beautiful run to the upside? Look at that. Look at that chart. Look at that. Talk about, some people would call that a doji. That's not a doji. That's just that's something that just got kicked out a bit. IBM, I used to work there. I don't know what to say about IBM anymore. As far as I'm concerned, their cycle, they've come through this cycle. Now they're breaking this low, and they're probably heading down towards the 125 range. But that's just my opinion. Then we've got Boeing down 4.5. Boeing, unfortunately, agreements with China, where most people are not aware that if you're going to be a manufacturer such as Boeing or Caterpillar in China, every year 1/10 of your product has to be built inside of China, so that at the end of 10 years, all of your intellectual property and manufacturing is now going to be situated inside of China. And so for the short term, Boeing does great, but they better be careful, because basically China will be building all of Boeing's parts after about 10 years, if they want to build planes inside of China. So just something to think about with these global conglomerates. McDonald's definitely going sideways here. I don't know how many of you guys and gals stop in at McDonald's, but it's been a long time for me. Travelers, another insurance company, coming down, falling down to support level within a trend channel. Chevron.
Take a quick peek at the euro.
Sure. In fact, I'll go back over to my global charts here, and as far as the euro goes, well, that's a 5-minute chart. Beautiful trend, huh? Look at it. I mean, it doesn't matter. In fact, my presentation, September 17th in Delray Beach, Florida, is going to be on trend channels. And you can just see this beautiful trend channel right here grinding its way higher. So we have, I love it when I see the symmetry. And look at that. And so that's on a 5-minute chart. So on a 5-minute chart, we've got just natural resistance coming in up here at about 117. Okay, we're closing right now at 116. And we've got support at about 115.20, but let's go all the way out to a weekly chart. And on a weekly chart, you can just see the patterns, or at least I can see the patterns. And some people are looking for parity to take place. We're coming there. We're getting down to parity where $1 equals €1. I think that it's not out of the question to expect that. If I go ahead and put some Fibonacci's, let's say from this low to this high. You can see that we have a 138.2 extension right here at parity, right there on the just a little bit below 1. And oh, I didn't want that. I encourage everybody, if you don't use Fibonacci's, to learn how to use them, understand the retracements and the extensions. And I had learned a lot from just sitting with a real good technical analyst way back when I was learning. A very, very short time sitting with somebody very, very well experienced. They're very well known. Carolyn Baroden, Fibonacci Queen. I sat with her for just a short period of time, and it's amazing how your learning curve, when you're sitting with somebody who knows what they're doing inside and out, it can shorten your learning curve immensely. Some people think, well, I can just go on YouTube and I can learn everything. Yeah, that's probably true. But when you're working with somebody who's willing to listen to you and understand the charts that you're using, or teach you how to use the charts that you want to use, or you're not sure which charts you should be using for different situations, such as here I'm using a different charting program. When Tom asked for the Forex, I go out to my Forex broker, and I'm getting real-time quotes, which have all my tools that I need, and I don't clutter up my charts with too much stuff unless if I'm drilling down into it. So this is a weekly chart, and you can see fib clusters coming up all over the place right here, right around parity. We've got another fib cluster right at current price. Notice we have right here 123.6 extension to 38.2 retracement, as well as a support resistance level right where current price is. We've got good support right here at 1.09. And we've got resistance up here at about 120. So we're right in the middle. And Tom, I don't know if you have considered using FX options. To me, I like trading and investing with long-term, and I sell short-term. And the FXE is an excellent instrument to use, and you can sleep at night. Well, you're in Germany, so actually that's not true. So I don't know if you've got access to other brokers over there to trade the euro.
Yeah, I use Interactive, so I have access to everything.
Same thing. Okay. So, but I like the fact that the ETF. When I was focused on forex, they used to call me Furst on forex. Did presentations on FX Street from 2004 to 2010, and there were times when I would be up throughout the middle of the night waiting for a European Central Bank announcement or their unemployment reports to come out, at 3 in the morning, or the European Open, or even the Asian. It was taking its toll. It's great for a while. People say the Forex market's a 24-hour market. That's the good thing. The bad thing, it's a 24-hour market. So the ETFs, I'm looking at the higher time frames. The chart patterns all work the same. I like to always, when I'm teaching people about chart patterns, if I pull up the euro pound, I believe it is. Is it the euro pound? No. Pound dollar. If I pull up the pound dollar and bring in a weekly chart, you can still see, is it the euro pound? Instrument, euro pound.
Incidentally, that move down on the pound dollar was where Joe Ross made his biggest his best trade of his life.
Well, that's what I was getting at. There's this head and shoulder pattern that I never would have thought could have gone as low as it did, and then it just continued to just completely plummet.
I think he told me he was short 20 contracts and made something like $200,000 on that trade.
It's an amazing thing, huh? If I close this and open up the euro pound, and it's amazing how these patterns just completely repeat themselves. If I go out to let's go to a monthly chart, make sure I'm looking at the right thing. Oh, it's euro pound. I'm so excited with the volatility.
Yeah, this is
anyway.
The day traders or the directional guys love all this volatility.
Exactly. All right. So with that, I think we are past we're 5:37. So that was good. I hope that all of you picked up a couple of tidbits of information. Feel free to contact me directly, jerrybfurst@yahoo.com, traderseducationnetwork.com, here at capitaldiscussions.com with Tom and Jim. And join us again on Thursday at 12 noon. We're going to discuss the week in progress.
And I'm sure we'll have quite a bit to talk about between now and then.
Absolutely. All right. Anybody else have any questions? All right.
Thanks a lot, Jerry. Really appreciate your insights and sharing all that you do. It's great.
All right, Tom. And likewise, you guys put on a great website, good infrastructure. We'll be back again soon.
Yep.
All right, everybody. Okay.
All right. Good night.
Bye.